Something just shifted in the US housing market. No headlines, no panic. But Wall Street noticed, and that's what matters. For months, everyone has been asking the same question. When will home prices finally come down? We've been watching interest rates, inventory levels, and waiting for that one big event to crack the market open. But what if the change isn't a loud crash? What if it's a quiet, almost invisible reset that's already underway? The kind of shift that big institutions see weeks, even months, before the average person? In this video, we're not going to look at confusing charts or scream about a market crash. Instead, we're going to talk about the subtle signs that the game has changed, what Wall Street is doing about it, and what it all means for you. For the past 2 years, the market has been defined by intense pressure. Buyers felt pressured to waive inspections and bid way over asking price. Sellers felt pressured to list their homes to cash in on record high values. But that pressure is now easing. It's like a balloon that has been slowly, almost silently losing air. We're seeing a significant shift in buyer behavior. The frenzy is gone. Buyers are taking their time. They're negotiating again. They're walking away from deals that don't feel right. This isn't just because of higher interest rates. It's a psychological shift. The fear of missing out, or FOMO, is being replaced by the fear of overpaying, and sellers are feeling this. Homes are sitting on the market longer. Price reductions are becoming more common. This isn't the dramatic crash people were expecting, but it's a clear signal that the power dynamic is rebalancing. The era of sellers calling all the shots is quietly coming to an end. It's a subtle but powerful change that's happening right under our noses, without any breaking news alerts. Now, why does this quiet shift matter so much? Because the housing market isn't just about houses, it's the bedrock of the entire economy. When the housing market changes, everything else follows. Think of it like this. Housing is connected to the banks, and the banks are connected to the stock market. It's all one big interconnected system. When homes are harder to sell or their values start to stagnate, it creates a ripple effect. Banks become more cautious about lending money, not just for mortgages, but for business loans and car loans too. This tightening of credit slows down economic activity. People feel less wealthy because their biggest asset, their home, isn't appreciating like it used to, so they spend less. Businesses see lower sales, which can impact their stock prices. We've seen a version of this play out before, where a change in the housing market sent waves through the entire financial system. It doesn't have to be a dramatic event to have huge consequences. A slow, grinding reset can be just as impactful over time. The health of the housing market is a leading indicator for the health of the entire economy. And right now, that indicator is flashing yellow. So if the mainstream news isn't covering this, what are the smart money investors watching? They're not looking at the same headlines you and I are. They're watching the flow of institutional cash. Big investment firms, hedge funds, and private equity groups, they move differently. They move early. They don't wait for the official data to confirm a trend. They act on the early signals. One of the key things they watch is rental market data. Are large institutional landlords lowering rents or offering more concessions? That can be a sign they expect housing demand to soften. They also track the movement of cash on the sidelines. When big players start building up large cash positions, it means they're preparing for opportunities. They're waiting for assets to get cheaper. They're also less emotional. They see the market as a set of data points, not a place to raise a family. They noticed the shift in buyer psychology weeks ago. They saw the increase in days on market. They understood that the peak of the frenzy was over. While everyone else was still caught up in bidding wars, they were already repositioning their portfolios. This is the key difference. They don't react to the news. They anticipate it. They follow the subtle clues, the quiet movements of capital, and they position themselves before the herd even knows which way to run. So what does this all mean for you? First, let's be clear. This isn't a crash call. This is not a prediction that the market is about to fall off a cliff. This is a signal. It's a sign that the market dynamics have fundamentally changed. The period of rapid, unsustainable price growth is over. We are entering a new phase, a housing reset. This could be a long period of stagnation, a slow price correction, or something in between. The key takeaway is to adjust your mindset. If you're a buyer, the pressure is off. You have more leverage now. You can take your time, negotiate, and make a smart decision instead of an emotional one. If you're a seller, you need to be realistic about pricing and timing. The market of 6 months ago is gone. And if you're a homeowner, don't panic. Housing is a long-term asset. The important thing is to be aware of the shift that's happening. The loudest voices are always the ones predicting doom or endless growth. The truth is usually found in the quiet middle. This reset is a return to a more balanced, more normal housing market. It's not a crisis, it's a correction. And knowing it's happening is your biggest advantage. Thank you for watching. If you found this perspective helpful, consider subscribing for more insights that go beyond the headlines. Stay informed, stay calm, and we'll see you in the next video.